Now, guys, we'll wait some minutes until a little more people connect, like 2 or 3 more minutes, and then we start. Right, in a minute or two, we will get started. All right, it's 3:04 here, so I guess we can already get started. Let me share my screen, and now we're ready. All right, so thank you very much for connecting. Today is the 5th webinar in our series of 8 webinars. We are just halfway, and each of these is like about a different topic that actually someone asked me before. So you don't need to watch the whole series at all. They are about different topics. But yeah, like we today we will cover one of the topics that actually when we give other webinars to VC funds, to accelerators, or like corporates or whatever, this is usually one of the things that they ask us more often. This is SaaS. It's the most common business model, as we will talk about it, and its main metrics and benchmarks and stuff like that. So we will be covering it in like around an hour. I guess I'll try not to be like too short or too long, and leave some time for questions. But as always, and as in the other webinars as well, feel free absolutely to stop me at any time. So if you have a question, like either write it in the chat that I would see it over here, or yeah, write it in the chat. Tell us in the, like, you can unmute and speak up directly. You can use the function of Zoom of raising your hand, whatever you prefer. But essentially, I think it's better like to have questions during the presentation than at the end. But as you wish, at the end, I will leave some time for questions as well. So, well, at the beginning, like always, I'll do a little quick introduction about myself and about the Startup CFO. And then we'll define SaaS and like a couple of comments on SaaS and its advantages. Actually, it's very similar to what we discussed last week on the different business models. And then the huge part, or the biggest part of the presentation, on the main KPIs of SaaS. SaaS, as we will mention later, has like a very particular vocabulary and dynamics. So this is like where we will define it, and where we will define like what's a good, what is good and what is not according to the main benchmarks in SaaS. Then we will not go in too much detail, but I want to show you how to build KPIs for a SaaS business. It is actually like one of our clients made the joke, hopefully the joke, that he told us that he was only our client because we knew how to do that, how to prepare that table. So we'll show you. You will see that it's not like that magic, but it is true that it is framework that is way more powerful than it seems. And then, yeah, last, as I mentioned, hopefully we'll have some minutes for questions or whatever. But please, I'd rather like have you interrupt me and spend more time in a slide if you have any doubt or comment or whatever, than necessarily wait until the end. So first about me, I'm Jaime. I studied physics between Madrid and Boston. As you see, things changed a lot from physics. I started a PhD that I never finished. And then is when I switched to the business world as a consultant in McKinsey. I worked at McKinsey for about 2 years. And then is when I moved to startups and already in the finance department. So I worked full-time on Track and Geoblink as CFO. And then is when I started having like projects that friends of mine or former colleagues or whatever would tell me like, can you help me with the reporting? Can you help me with this business plan? Investors have asked me for these KPIs, etc. And I started like giving a hand to some of them. Then I had too many projects, so I became a freelance, and they had too many projects, so I tried to scale the business as the startup CFO. Sorry. So what do we do in the startup CFO? Our main business line is to offer fractional CFO services for early stage startups. So startups that still do not need a full-time CFO, but that someone needs to take care about them, the financial operations, the reporting, the business plan, the fundraising, all the administrative stuff, etc. Usually, many times, it's the CEO that takes on that role in an early stage startup, but that's not the best use of their time. The CEO should focus in product and sales, what he does best and what he likes best. So far, as CFOs, we have worked with over 75 early stage startups, including all the business lines. I think we have worked with almost 200 already. In Spain, we also offer like accounting services, public funding, legal, and internationally, we offer both CFO services and consulting services, and also to prepare fundraising or other type of strategic projects. So far, we are already a team of 25 people. And recently we opened our first international office in Berlin. So right now we have presence in Spain and Germany, although we offer our services to clients in many other places. If you want to find more content like this, you can check our YouTube channel. If you look at the Startup CFO on YouTube, or join this webinar series. Some of you, I know that you have arrived to this webinar through LinkedIn. So maybe like you just got the invite for this webinar. But if you like, I think Rocío or someone in the team can send the link to the landing page to sign up for all the webinars or to see the previous ones. But again, in YouTube, you also have everything that we have covered so far in both Spanish and English. So getting to today's webinar, why is necessary a webinar on SaaS? Because SaaS, it's the most common business model among startups. It's estimated, I was checking it before, that around 70% of startups are considered SaaS. As a software as a service, as we will see now. So I think that we are like it's our biggest expertise, although we have like all types of startups, and it's the most useful to give to anyone in the audience. SaaS, in my opinion, is not a very complicated business to understand. In fact, I would say it's relatively easy, but it is true that it has a very particular vocabulary. So startups already have their own vocabulary, which I think that's why, for example, a course on startup finance like the one we offer makes sense, because it's a different vocabulary and a different situation than a normal corporate faces. So SaaS, it's like a sub-segment, and you will hear many things like MRR, ACV, and acronyms like that are like their own for SaaS. And modeling a SaaS, it is not trivial. It's a weird situation because modeling a SaaS is not easy, but all SaaS models are very similar, even if they are from very different industries. It doesn't matter that it's a software for HR. It doesn't matter that it's Netflix. It doesn't matter if it's like Geolink, like a location intelligence software for companies. In the end, the models are very, very, very similar to each other. So it's good to see like a session on that, and then easy to replicate in many SaaS. So first of all, what is a SaaS? So SaaS, the definition is a cloud-based application delivery model centralized on a server. So this, I guess the older from you know that we used to like buy CDs and then install it in your computer, and it had a license number that you could find in the box or stuff like that. That's an on-premise software, and that's the software that existed before. The SaaS is cloud-based, so you can access it directly, and you only need connection to the internet. So this has a ton of advantages, both for the client and for the startup itself. First of all, is that the client only needs an internet connection. No CDs, no like distribution chain, therefore no margins lost in between. You just can like download it or give access to a license or something. Simple and accessible for that reason. Usually compatible with all devices. It is true that many SaaS, like if it's a B2C, they may focus in mobile and then in iOS and Android. But in general, like it is very easy to make them like compatible with different devices, even laptop to phone or iPad or that. License, actually, I will use the word more times. Technically, it's not a license anymore, but it's a subscription model. So you don't buy a Netflix license and you have it forever, but rather like you are subscribed to Netflix, and that's why they charge a fixed amount per month to you. This is more technical, but the provider company is responsible for the data security. So, you know, if you buy a CD and you install it in your computer and then things go wrong, it's on you. But in this case, you know, the company usually has a CISO, responsible of security, that is responsible for avoiding data breaches. Obviously, for the startup itself, is super scalable. You don't need any distribution chain, and this is like half truth. But in theory, you wouldn't need twice as many people to sell twice as many subscriptions, or even like 10 times or even 100 times. Of course, there are some fixed costs that are bigger for a huge company than for a tiny company. But the principle is that Netflix doesn't suffer particularly if 100 more people sign up to it, because it's very, very, very scalable business. You can personalize it, which means that it is super easy that a client starts buying a tiny part of the software and then updates it, and then like gets access for more money to different modules of the software. So this makes a lot of sense. Like for example, in HubSpot or in almost whatever SaaS, you see that like you have different packages. And that makes total sense. I guess a huge corporate uses the most expensive and a tiny SME uses the smallest one, which gives you access, by the way, to a bigger market, the tiny guys and the big guys. And also related to this is that you can automatically provide like the updates for everyone. If you launch a new module, tomorrow everyone has access to that module or the possibility to buy it. If you made an improvement in data security, tomorrow everyone will have it, and so on. So that's huge advantages. And that is why there's a huge trend towards SaaS in the industry, which is beneficial for both business and customer. I wrote SaaS and also like SaaS, as you can see, like anything as a service. Because actually even our service of fractional CFO, many people call it CFO as a service. It's not software, but it like creates a link to technology, and it creates a link to the concept of a monthly subscription. By the way, the subscription doesn't necessarily need to be monthly. We will see that it can be annual, but still that a periodical subscription. So you can see like a ton of things now, like banking as a service, for example, this type of neobanks, or well, I even read yesterday or today, like cash as a service, which I found a little too extreme, but you will see this as a service everywhere. In fact, like traditional huge hardware businesses for software, but that they operated on licenses, are switching to SaaS. Microsoft is no longer a huge fee that you pay for the license forever, but rather you pay, I think it's around 10 or 11 euros per person per month. Apple, which is still obviously huge in hardware, but there's articles that you can find how like they are moving on to revenue. To subscription revenue. And by the way, the elephant in the room is that obviously for the company, if you do that, then the business is way more predictable. So, you know, Microsoft now is like, they know they're going to have the same users than last month, plus some of them that are new, plus some minus some of them that they left. But it's a very, very, very constant business. And also, by the way, you don't have an entry barrier, such a high entry barrier for the client. I'm not committing to pay 100 euros now. I'm committing to pay 10 now, 10 in a month, 10 in another month. And if I want to cut it, I cut it. If I want to keep it, I will never pay a big amount. And in the long term, I'm paying more. So that makes a lot of sense. SMEs, well, there are some statistics here in which you will see that SMEs and CIOs and stuff, they're investing a ton of money in SaaS solutions. Even us, that we are a tiny SME, we have probably like around 30 or 40 SaaS solutions. And some statistics down here that show that the trend is huge in the last year. So moving to the KPIs. By the way, again, cut me whatever you want. Here we're going to get more technical. We will see this part, we'll divide it in the MRR and its drill down, which we will see that it's more important than the MRR itself, the concept of bookings and revenue recognition, ratios and efficiency metrics, and one of the most interesting for anyone in the audience, the benchmarks, what is good and what is bad in SaaS metrics. Okay, so this is the most important slide of the presentation, and this needs to be very clear, and that's why we will also see like a little scheme in Excel. The key metric is the MRR. The MRR is the monthly recurring revenue, and the definition is that it's the sum of the recurring monthly MRR that each customer brings us at any given day. So this, like the easiest way is to see it with examples. It is not the same than what is invoiced. So if we submit an invoice for an annual license from January 1st to December 31st, that is 12,000 euros, then the MRR is 1,000 per month. That's the monthly recurrent revenue equivalent to this 12,000 for the whole year. So you are not, you don't need to account, or you shouldn't account like 12,000 euros in January, that's great, but rather to say 1,000 euros each month of the year. And by the way, we are not including all the revenue. We are including only the recurrent revenue. So again, monthly recurring revenue. So the recurrent revenue is not everything. Usually in a SaaS business, around 10% of the revenue is non-recurrent, and that is completely fine. A ton of times, as SaaS will do like consulting services that at the beginning they do in a manual way, but in the end, after the project goes fine, they incorporate it to the product. And this is completely fine, but it's not recurring revenue. Or they may have like all their business lines, or at the beginning they may have started like with an on-premise solution, and now they are moving to SaaS, and therefore like not everything is recurrent, and that's totally fine. That's revenue for the company, but it shouldn't be part of the MRR. So let's see a quick example here that I prepared. Very, very, very stupid example in Excel, but I guess you guys will understand it. So imagine we have client one buying something like the example we were saying before, from January 1st to December 31st, with for 12,000 euros. That's 12 months. And then we have like 1,000 each. Another client bought your license for April to March next year. So you have 1,000 each month, and then these three would be another 1,000. This guy is only 1,000, and also January to December. Fine. This guy pays 12,000, but only for this is actually 3 months. Actually, yeah, I have it wrong over here. So yeah, this is actually a 3 months. So and this is a 4,000. Anyway, so this is no, sorry, it's between February and March. Never mind. So only for 2 months they paid the 12,000. So that's 6,000 in February and 6,000 in March, and that's it. If they had renewed, then we would have more. You see the same example: 18 months, 6,000 euros, 333 each month. That it started last year and it finishes this year. You see, and then the MRR is just the sum of all this. Different clients, what is their impact in the month we are at? Okay, so not exactly the revenue, because we are not including the recurring part, and everything is deferred monthly, regardless of when it was invoiced, and if it's like an annual license or bi-monthly or whatever. The ARR, which is another important example, many times you may hear with SaaS MRR or ARR, and they can be used interchangeably, but there's a factor of 12 between. The same that this was monthly recurrent revenue, this is annualized recurrent revenue, the annual recurrent revenue, which is simply this figure that which was the sum times 12. If we made this month annual, how much recurrent revenue it would bring us. So it's simply a factor of 12. Then, I mean, this was hugely important. So like if anyone has like any issue with the concept of MRR, now is the time to explain it. We will see that it gets more tricky with time. So actually, changes in MRR give more information to us than the MRR itself. Okay, this is crucial. So the MRR of 1 month, of the month of June 2023, is the MRR of the month of May plus the new MRR that I got this month from clients that never existed, plus the reactivated MRR, clients that I used to have canceled and then came back. This is usually very little. The expansion of the MRR, clients that I already had, but now they are paying me, minus the downsell or contracted MRR, clients that were paying me more and now they are paying me less, but I didn't lose them, and the MRR that is lost or churned, the clients that I had and now I didn't have. So you see, these are the 5 possible changes that you can have from 1 month to the other. And this is much more important than just the figure itself. Because the figure itself, and we will see examples later, if I see that it's growing a lot, but it's all huge new MRR and huge churn every month, huge MRR lost, then you have a pretty bad product. You attract leads very well, they sign up, but then they churn very quick. So that means that your product is not good. We will see that our main goal is to have recurrence, and that the recurrence is as long as possible. So I think we already defined these amounts. MRR that is new is from clients that you never had, reactivated where your customers left and have come back. Upsell, you had them, but now they pay a higher price. This, I remember that I was surprised the first time I worked with SaaS, that there was so much upsell. To me, it's like, if I'm buying something, I don't want to pay more amount, same thing later. But the answer here is, it may not be the same thing. They may be buying more modules now than they used to. Also, you may have reached an agreement in the past that said like the first year is 1,000, but then you switch to 1,200. So then you have an upsell there. Maybe they are consuming more of your product, and then it's a matter of number of API calls, and now they surpassed some limit, so they are paying a higher price and stuff like that. And downsell is the reverse, and it can be like that. Like they cancel one module, but they are staying with you. And churn is when you lose them. The percentage variations, in fact, are more relevant than the absolute numbers to compare between startups. So this is like a pretty cool thing. The percentage variations here, you can have benchmarks that work at any stage, which is pretty cool. We will see now an example. And first, by the way, you may be having, especially if you have already worked with SaaS, with some concept that you are like, okay, hold on, but this usually gives us some problem. What happens if a contract starts at the middle of a month? Should we count, imagine you sign 12,000 euros from January 15 of this year to January 14 of next year. What do we do in that month of January at the beginning and in that month of January at the end? So you should not account for half of the MRR in each of them. Why? Because you will show an upsell that in truth, it hasn't happened. The client is not like paying more in February because you did something to your product, because now they are paying for another module. They are paying more because simply they started in January 15. So no upsell happened. What we do in these cases is to count always the last day of the month. So in the first January, we would put 1,000 euros, and in the last one, 0, if they don't run away. Currency exchange. This may trigger like many issues, like our nice equation here may fail because of exchange rates and from one month to the other. So what we do usually is to calculate with the same exchange rate for both. And if it's something like crucial in the company that we are analyzing, then we may adjust this equation of like, and how much of the difference comes from exchange rate. But it's usually not really needed. And then the recurrence, again, like I was giving you in the example before, an example of a license that lasted 2 months. So what's that? It's a trial, but it's a trial, like trials, should we count them or not? If a non-recurring service is hired for like several months, that is MRR or not? In my opinion, it should only count, anything should only be counted if your goal is to have it forever. So if you have a trial that you charge only 1,000 per month for 3 months, but your goal with that trial is that they stay with you forever, like they continue after the trial, that's MRR. If you did it as a point project with them that you know that at the end is going to stop and maybe come back in a year or like in other business line or whatever, then that's non-recurring revenue. This again can be argued, obviously, but this would be like a conclusion. And let's see an example, a sanitized example of a real client of us. Yeah, like for example. So, all right. This is like a client of us, you see, pretty old. I always try to pick old reportings so that we are fine. We see that in this client, we have the MRR figure and then the drill down. We always show it this way. Also, by the way, we show it this way. This will be the MRR. Like we'll talk later about well, I can define it now. The net churn is the sum of everything that is not new MRR. And this, your goal is that it's negative. What does it mean? Like usually you churn clients. You churn like, imagine 1,000 euros. But you have upsells that compensated that. So like your total churn, that is usually a positive number, like you compensated with upsells. And therefore, you see that, for example, of this 181,000 MRR, like you had a ton of upsell, some reactivation, and very little churn, which means that only those clients already implied to you that you're having more MRR. Your existing clients in June already brought you more money in July. On top of that, you got 3,000 euros in new MRR. This is actually really great news, as we will see later. And then we also like drill down the same analysis with the accounts, the ones that like are new, reactivated, upsold, downsold, and churn. And of course, some of their parameters. But then it's like the percentages that I was telling you here. In fact, this is crucial because this is what will let us compare among different SaaS businesses. I come here and I see an average of 1.3 in upsell, and I think it's pretty good. I see churn that is 0.7% on average, and this is really, really, really good. I see net churn that on average is negative, and I see that it is really, really, really good. So these numbers here can compare businesses that are relatively small and businesses that are as huge as SAP, for example, or Netflix, and can help you compare like the retention. People usually sign up in Netflix and stay for years. So I'm sure they have like very small churn, and this is great. But my point is that these charts and these percentages are probably not that different in a company like Netflix and in a company like one client of us that, of course, it's very small. This is the cool thing of knowing about SaaS, that if you know about SaaS, you know about all the SaaS business. Of course, a little simplification, but not too big of a simplification. Also, by the way, this many times, this is just like a couple of stupid examples, are like, there are visual representations for this type of evolution. Again, the concept is you have the MRR in 1 month, and then it changes from 1 month to the other, due to churn, due to upsells, and it gets you to the following month. In this example, is with the years, from 2016 to 2017. And this is another way to represent it, that is downsell and churn on the bottom, and new upsell and reactivation on the top, and you always want to see more on the top than at the bottom. Again, I'm not very visual, because there are many cool charts like this, but yeah, just to mention that there are graphical representations of this. Okay, and Now let's see another important concept that is a little confusing many times and that I've seen like creating arguments, which is bookings are the revenue secured by signing contracts. When you see a SaaS business, and in fact, with the example we were having before, I think we have it here. Yes, bookings over here. And by the way, it already said annual. So the booking is the revenue secured by any signed contract, or that we secure when signing a contract. Watch out, it's not the same than MRR, or it's not necessarily annual. If you guarantee a contract that is 6 months, or if it's 3 years, whatever, the booking is the money you're bringing to the company with that contract. If it's a monthly subscription, you just say like, what is your bookings? You read that month. Then you can use the concept of annualized booking. The annualized booking resembles much more the new MRR or the new ARR, actually, because it's the annualized version. But in theory, bookings, as they themselves are, is the money that you just guaranteed for the company. Again, to standardize, we may say like annualized bookings. Okay, let's make them annual, or if it's like a very long contract, let's take the first year, or there are concepts like that need to be defined company by company. It is independent of when the customer service begins. Some softwares are like pretty complicated, B2B, very expensive. They need some setup with the client and stuff like that. And they may start or they may be invoiced way later. But the signature is today. So the bookings we're counting are today's signatures, today's securing of revenue. And therefore, this is why it's usually the objectives of the salesman. How much money you sign this month, and you're getting paid a commission on that. So this is again a tricky concept, and this can be argued as well, but it's important, especially if you are starting a SaaS business, that you understand this difference and that you align it with your sales. Then there's like this a little more technical, but it's important, which is the revenue recognition. Accounting revenue should be very similar to the MRR, but it will almost never be the same. So the example I always say of the 12,000 euros in January, that should be like 1,000 per month, every month of the year for MRR, that should be the same in accounting. It's the right way of accounting. If you don't do it right, then, and this is more technical, I won't go into in detail there, but if you don't do it well from the start, fixing it accounting-wise, it's almost impossible. So like from the very first invoice, please defer the revenue. Tell your accountants to defer the revenue. And therefore, you will say that, well, then the MRR will be exactly the same as the accounting revenue. Not necessarily. And why is that? Because, for example, you may invoice, you may sign a contract last day of the month that already counts for that month, and you send the invoice on the following month. You forgot to send the invoice. You need to correct something of the amount, like a couple of months later, you do like a discount for the client, so you send a credit note. Then you use a different exchange rate for different currencies, with the moment you submitted the invoice and the moment that you accounted for whatever. Then maybe at the beginning in your invoice it said like January to December, but in the end, due to delays in the setup, is April to March. Things like that make MRR and revenue not much, and that is fine. But as long as that difference is small, that positive months compensate with negative months, that you track it and that you explain. So it almost never matches to the cent, and that's fine. But if for example, this is very typical, that is a big red flag for funds, that someone tells them, we have an MRR of 100K and last year 50K, whatever, and they go to accounting revenue, and this year they only see 20K. Like, this is impossible. So they should be very similar. The MRR in the different months, and the revenue that's the recurring revenue of the. But again, it's fine, but it should be explained and it should be small. Anyway, so what are like basic efficiency metrics that we should that we should track in a SaaS business, and this is where like we start getting more over here. Well, and we will give some benchmarks afterwards. The MRR growth, it's simply, I mean, is the most simple. It's like the growth of any metric is the MRR in this period times the MRR, divided by the MRR in the previous period minus how much it grew percentage. We will give a benchmark of this. It can be annual or it can be monthly. Then the average revenue per account is the average MRR contributed by each active account. I have 100,000 euros of MRR given by 100 companies, then my ARPA is 1,000 euros per company. That's it. My ARPA is 1,000 euros. The ACV is 12 times that, the annual contract value. This actually is like the same relationship between MRR and ARR. It's not different. The ARR, by the way, it was again 12 times MRR at any given moment, shouldn't be mistaken with the annual revenue. It has nothing to do. It's simply like the MRR of the current month times 12. By the way, every startup wants to see their ACV growing. So this is like if you are modeling a SaaS business, or if you are like, or if you are selling it to a VC to invest, then you want to see that at the beginning you will sell to tiny companies, and in the end you want to sell to a huge company, a huge corporation like to Google, whatever. So therefore, obviously, Google will pay more money for your product than would a tiny business like mom and pop business. So you start selling to small business and you end up selling to great businesses. This in a B2C may not happen, but still you want to say that you are going to offer more functionalities that will make people pay more. Exactly. So track the evolution of the ACV that you are promising or that you have been having in the past. And then, like in any startup, is the LTV and the CAC. Again, remember the webinar we had on unit economics, which is the most crucial, like of modeling the business plan for startup. So this is the most crucial in any startup. How are they calculated in a SaaS business? It is the LTV is the ARPA, average revenue per account, of the new bookings times the gross margin times the lifetime in months. It's a software that is 1,000 euros per month. I keep 90% gross margin, 900. My client is expected to last 5 years. Or like my current clients are lasting 5 years. So then I would have 4,500 actually 60 times, like 5,400, I think, something like that. Lifetime value, 54,000. Or which is the same, ARPA, the new bookings, times gross margin divided by the month. This is simply like the money that the account should bring you over time. And the customer acquisition cost, we always recommend to write fully loaded, the total sales and marketing cost, including staff and operating cost, divided by the new booked accounts. Again, the concept of bookings. Maybe the contract starts later, but I'm spending the money in sales and marketing now. By the way, in these metrics, usually the quarterly averages are taken. It's like a rolling average, because then like if you book 3 accounts or 1, this number may change a lot, and the metric does this. If you take a rolling average, then it smooths out. And then there are more elaborate averages and efficiency metrics. Again, I will not go into much detail, but one of them is the payback. We covered this in the first webinar. The time that an account takes to compensate its own acquisition cost. So the ARPA of the new bookings times the gross margin, in the example before, 900 euros. The CAC divided by that. If the CAC was 4,500 and this is 900, the payback is in 5 months. After 5 months, that company would have covered its own acquisition cost. Sales efficiency. How much money you spend in sales and marketing to get 1 more euro of ARR. Capital efficiency. About this, by the way, above 1 is good, below 1 is bad in very general terms. Capital efficiency, MRR change over operational cash flow. Actually, the burn multiple is almost like the inverse of this, and this is a KPI that is getting more and more common. So usually this, like above 10%, is pretty good. MRR at maturity. This one I really like it. That's why I put great. If you have like 1,000 euros of new MRR per month and a monthly churn of net churn of 2%, then or of 10%, let's say, then let's see if I made the numbers correctly. Yeah, then your top would be 10,000 euros, because in 10,000 euros you would acquire one more thousand, but you would churn 10%. So this is very important to track, and this obviously shows you that, like, in order to make the limit of your startup the highest, you should acquire more and you should lose less. Obviously, it's very intuitive, but I really like the concept of by now we could reach this amount in here. If you want more complications and more cool stuff, I highly recommend this this website that is called the SaaS CFO. Despite the name, we have nothing to do with them, but I really like their name and their website. So let's see some examples that we use in reality. This is actually our base model that we use for like our SaaS companies. I will go in detail, but I will just show you, like, for example, this is a real client in which we, well, real model, not real numbers, and real client that we would use to calculate. And in fact, the LTV CAC is not even like well calculated here, whatever. It's easy maybe to put it here. Yeah, exactly. So here we would track the LTV according to like the churn rate. By the way, we always put a limit on the lifetime. If you have 0 churn this month, that doesn't mean that you will have 0 churn forever. So we put a limit usually in 5 years. Depending on the product, it can be from 3 to 10. Gross margin 90%. The ACV of the new bookings is 80,000. So you would expect that these clients bring you 360,000. 80,000 euros times 90% times 5 years. And we take rolling averages for the reason I was telling you before, that it's a more consistent metric. The CAC, the total amount that we spend in acquisition between sales and marketing, divided by the new booked accounts, and also we take the rolling average. And the sales efficiency, for example, here, a change in annualized revenue divided by the acquisition cost spent in that month. Each euro spent in growth return 3.2 euros in a new annualized revenue, which is good. Above 1 is good. Actually, let's see some benchmarks here. Again, it's something very powerful, and that's also an important message that I would love to convey to you guys, is that many of these benchmarks, not to say like all these analysis that we just made, apply to all SaaS businesses. I'm 100% sure that in Netflix, someone has like a dashboard that says, you see MRR, new MRR, reactivation, upsell, downsell, churn, and they measure the net churn and everything like that. Of course, in a company like Netflix, probably they would then split it in different geographies, you know, like you can like drill down and see different sub-metrics, or you may target like people under 30 or whatever. Maybe also like in some other products that may have a free trial, for example, and this is a conversation I was having the other day with other CFOs, how to account a free trial. In my opinion, a free trial, as it is free, it has nothing to do with finance. It may be a very important metric in terms of marketing, and you may need to model it in terms of like how many people that do a free trial end up buying it. But technically, it's not part of the amount. But again, like that, this doesn't mean that these are the only analysis that you can make in a SaaS company. But what I can guarantee you is that every SaaS company needs to track these numbers. And the benchmarks, again, are very, very, very consistent, especially in B2B, or like there are benchmarks for B2B and benchmarks for B2C. B2C is a wilder beast. So I'll focus especially on B2B when claiming these benchmarks. So the holy grail of SaaS is negative net churn. Again, you have your current clients are going to pay more the next month than they are paying this month. You're going to lose some of them, but among the others, you're going to have more money. You're going to have more money than the one that you lost. Okay, you can stop me at any time. This concept is pretty important. So that's what is called negative net churn. On average, you earn money. more money from your previous client. This is the holy grail. If you have that, please put it in the cover of your pitch deck. It's crucially important. This means a lot. This means that like the customers you have, they already stay and buy more. So your product is really great. Obviously, product development is always working, but you already hit somewhere and you already had product market fit. Also, something very important, you don't depend on new business to grow. You would keep growing just with the existing customer. And this is obviously, by the way, if the future follows the past, but like if you have had that recurrently, then you can expect that for the future. This is great. And this, by the way, it's something particular of SaaS companies that it's a huge advantage. A SaaS company, if it's already big enough, if it's already like about 1 million, 2 million ARR, then it is very difficult to fail completely, to go bankrupt. Because then the company has like a lot of revenues that are guaranteed if you have like 0 or negative net churn. If at some point you're like really in danger, you can cut in half your stuff. Of course, your costs. Of course, no one wants that, and it's a painful process, and no one likes firing people. But if you want to survive, you can, because your revenue for the future are guaranteed. In other types of businesses, you need to keep making business month after month. Also, by the way, and this is a benchmark that I didn't put, the gross margin in a SaaS business is around 90%. We covered it, I guess, in one of the first webinars. The gross margin in a SaaS business is usually around 90%, between 80 and 97. So this means that if you have a couple of million ARR, then you expect 1.8 million ARR, and you can cut your spending such that it's below 1.8, and you don't need external funding. In a marketplace with 10% margin, then it's very difficult. You need to keep creating business month after month, and with half of the team, maybe that's not that easy, and your margin is very low to cover for your expenses. In general, the most important metric, I think, are metrics related to retention. People tend to focus on vanity metrics, like new MRR, and they should focus much more on your churn percentage. So your monthly gross churn should be under 3%, and the monthly net churn under 2%, and that will be good. The smaller, the better. But above 3 of monthly gross churn would mean that every year you would lose above probably 50% of your MRR, which is not good. You didn't prove that you have like a really recurrent product. You have a product that is, like in 2 years, your clients only last 2 years. Depends on the rest of your metrics, but that doesn't sound good. 3% would be like almost 3 years. 2%, 4 years, stuff like that. Then in stability, funds seek an MRR growth of about T2, D3. What does this mean? To triple 2 years and to double during 3 more years. So if you start, imagine, let's say, with, I don't know, 100,000, then you would want to see 300,000, 900,000, 1.8 million, and 3.6 million. And 7.2 million. I think I did it right. This is very difficult to achieve. Not many of our clients have achieved that, but this is like more or less a good reference to what is crazy on one direction or what is definitely not successful in the other. If you are aiming at like growing 10% per year for 5 years, this is not a business for a VC, at least. Then is the famous rule of 40. The rule of 40 is that the MRR growth plus the EBITDA margin should be higher than 40%. What does this mean? That if your MRR from 1 year to the other doubled, it grew on 100%, then it's fine that you're losing 60% in terms of EBITDA. If you tripled, you grew 200%, then I understand if you're losing 160%. You know, the thing is like, if you're growing a lot, you are allowed to lose money, to put it that way. You know, you're investing truly in growth. But not the other way around. If you are growing a little, you know, it's like you are not investing a lot of money to just grow a very little, so you should be spending less. Very general rule of thumb, but it's an objective and not easy to match. And also something important, and this is like a very, very general rule of thumb, don't take it too seriously. Don't take any of these benchmarks too seriously, although, again, they allow us to compare very different businesses, is the valuation. The valuation many times in a SaaS business is a multiple of the ARR. So for example, if you are gonna like raise a funding round and you think that in 2 years you're gonna have 2 million in ARR, which would be great, by the way. Well, in ARR, yeah, it would be pretty great. Then you could expect that by then someone is gonna value your company in around 20 million. This may make you like say, all right, so now I'm gonna raise a funding round of like 5 million valuation. I'm just raising 1 million, so I'll get there, stuff like that. Okay. This is super general, but it never goes, or it almost never goes like orders of magnitude different. So for example, and this is public, Holded was sold by on a multiple of 26 times the ARR. Wonderful. Or we have seen like funding rounds that are being funded like higher and below this figure. But it's usually like a pretty good reference. So, you know, it may not be 10, but be 15, or it may not be 10, but be 8. It also depends, those variations around that 10, on many other factors. If your company is called AI by now, that everyone is crazy about artificial intelligence, then probably your valuation is higher. People are like more interested because they see a lot of potential. If you have a company that is growing a lot, then the valuation may be higher. This is like in the stock market. If it's growing a lot, you're willing to pay a higher price over today's value because you assume that it's going to keep growing. Also, by the way, we have seen crazy things, or there are things that are not so crazy, but other factors play a role. There are many transactions that are very expensive of companies that they don't have any revenues, or the sector. Well, it may depend on many things. And something a little technical, but again, this is what our client always said that it was like the holy grail of what we did, is how to calculate all these KPIs, especially the MRR drill down. And it's not more complicated and not easier than the following. You need to build a table first, in which for each account or customer, I'm using it in the same, it has like the MRR for each month. We will see now examples. That may come from invoices and contracts. We always suggest to do it from invoices, such that each invoice you can say the total amount and from what month to what month. And that will help you create this client, this month, I need to account for X MRR. And also another table that it says like, okay, if this was the evolution of the MRR month after month, here it happened an upsell, here it happened a churn, here it happened a new MRR, whatever. We will see now an example. And then that will help you to say, let's build the KPIs. Now I know when and where and how much was my new upsell, churn, revenue, MRR, and stuff like that. To make it a little more visual, you have here like client 1, client 2, and the client M. And you will see in February, for example, the MRR that each of them had, which may be 0, 0, 100, 200, 0, 1,000. And that table, like for all the months and all the clients. And here, for all the months and all the clients, you mention like, what happened? Here I had an upsell, imagine, because this was at 100 and this was at 200. So here it would be upsell. If it's 200, 200, 200, here it would be blank. And here for every month and every client, you mention if anything happened. It's new, reactivation, upsell, downsell, or churn. And with that, you can come back here and say like, okay, so this was my new MRR this month, this was my downsell MRR this other month, or whatever. So how does this look like for us? So for example, we have a tab that is called accounts always. And this comes from the invoices or the clients. This is again a sanitized example. So this reading from like some input KPIs or from invoices or whatever, this shows you each client, what was the MRR for each month. And then here, what happened? If you look at the formula, it looks pretty complicated, but it's not. In the end, it says like, if the MRR was 0, until this point, and now it's not. Let's say new. If last month was 0, but in the past used to be higher than 0, then it's reactivation. If this month is higher than the previous month, like here, it's an upsell. So you see here an upsell. And stuff like that. And here, with no huge effort, just like with a little Excel mastery, but not too bad, you can start adding up like this is the sum of the new MRR for Europe, for example, again, this sanitized client. And this was the upsell, for example, and the rest are zeros. So, so this would mean that, yeah, like this is how we move from the MRR this month to the MRR this month, by some new MRR and some upsell. These tables, we can like spend a good time, like a good amount of time looking at them. Again, the numbers don't really make sense over here because this is a sanitized example, so don't pay too much attention to that. But my point is that you can like keep looking at this and see if these numbers are healthy and stuff like that. Another one that is crucial for us is the cohort analysis, but we will get to that in the next webinar. So we gave a lot of information here, like a lot on SaaS, some more technical, some less technical, whatever. Is there any question, comment, whatever that you saw that you think like, okay, in our company we do this, or we are transitioning to a SaaS and we are thinking this? Anything at all, or like in benchmarks that VCs may want to see or not see, or anything? Happy to answer, either via chat, or if you unmute, or raise hand, or we do it here. So,
yeah, thanks a lot for your time. I wanted to ask whether we could jump back to the net churn formula, please.
Okay. Perfect. So the net churn essentially is, let me get back here. It's everything but for the new MRR. So the sum of the reactivation, the upsell, minus the downsell, and minus the churn. Okay. Again, it's more like about the concept. The concept is any variation of your existing clients in May that happened like in June. It is tricky, the sign. The sign is like pretty tricky because you call it net churn. So if you say churn, you are like, okay, you expect usually, I mean, the most common thing is that you lose money. Like your previous clients, maybe some of them pay you more, but you lost more clients. Yeah. That's what is expected. And that is what it would be positive net churn. Like you are losing more money than you are making from the existing clients. But if you have more upsell than churn, then it's like your existing clients are already paying you. And
so it's subtracting the expansion MRR or new MRR, however you want to call it, with the churn MRR, and then you divide it by the base MRR, right?
Exactly. I would add as well reactivation and downsell, but like to be expansion. Exactly. The concept is exactly the same.
Thanks. Thank you.
You're welcome. Anything else? I think it's 59, but like we could go for some minutes if you want. And if not, let's move on. In any case, by the way, and I'll write my email here. Let me know if you want to, if you have any doubt, if you want me to share a presentation or whatever. The materials, I guess we would like cap it, some of them, and like we will. Part of it, again, as the client said, was like a more. It's like more business secret, to put it that way. But obviously, happy to share a presentation. Happy to answer any doubts, or if you schedule like on 1 hour to talk about anything, you know, happy to see that. And also to tell you that we still have 3 more webinars coming. So for next week is cohort analysis. In my opinion, a really underrated topic. Rocío just shared, by the way, the landing page for webinars in case you didn't come through there. So for cohort analysis, it's a super underrated topic, not so easy to understand. And I always say, half joking, that if I did a due diligence of a startup, I would like take a look at the cohort analysis, and if they are good, I would invest. This is only half joke. So, and many CEOs are not like following them, and they should. And this is a crucial analysis, and VCs care about this. So this is the next one, and then we have 2 more on sources of funding and on pricing, if I'm not wrong. So if this is all, thank you very much. and see you next Thursday in the next webinar. Thank you all for the attention.
Thank you. Bye.
Thank you.